Right now, the U.S. stock markets are closed for the weekend. We are looking at the final figures from the last trading session on Friday, November 14th, 2025, for Boeing Co., ticker BA. The stock closed at $194.52, ending the day almost perfectly flat, down just 6 cents or 0.031%. The session itself was a tight, volatile channel, with the stock trading between a high of $197.03 and a low of $192.15, all on volume that was actually lighter than average, coming in at just under 6.2 million shares. Now, on the surface, a flat close seems boring. It suggests a market waiting, an equilibrium between buyers and sellers. But this is the exact moment where the reality of the stock disconnects from the surface-level expectation. The immediate assumption is that after all the drama, Boeing is finally stabilizing. But the critical piece of information that this flat price hides is what just happened on Wall Street. In the last 48 hours, both Bernstein and Susquehanna, two major research firms with deep aerospace coverage, reiterated their buy or outperform ratings but slashed their price targets. Bernstein cut its target from $277 down to $267, and Susquehanna followed suit, trimming its target from $270 to $255. This is the real story. The expectation is that everything is fine, but the reality is that the analysts who get paid to model this company's financials are getting nervous about one thing: cash. They are telling their clients that yes, the long-term story is intact, but the price of this recovery, the sheer level of capital expenditure and cash burn required to get there, is higher than they first thought. This is the tension that defines Boeing stock right now. Let's establish the common ground, the narrative that most investors see, whether they are making a self-investing decision on SoFi Invest or managing a massive portfolio through Fidelity Wealth Management. The dominant belief is that Boeing has finally turned the corner. The evidence for this is compelling. The most significant piece of news in the last month was the Federal Aviation Administration's decision in October to finally lift the production cap on the 737 MAX. This was the cap imposed after the January 2024 door plug incident, limiting Boeing to just 38 jets per month. The FAA has now given them the green light to ramp up to 42 aircraft per month. This isn't just a number. It's a monumental vote of confidence from the regulator. It signals that the FAA, after living inside Boeing's factories for almost 2 years, is satisfied with the new safety management systems and quality control processes. For an investment in Boeing, this production rate is everything. It's the only path back to positive free cash flow. The bull case is simple. More planes out the door means more cash in the door. We also see the order book filling up. Just this past week, Uzbekistan Airways finalized a deal for 8 more 787-9 Dreamliners. Tajikistan's Somon Air committed to 14 new jets, a mix of 787s and 737 MAX. These are not small orders. They reinforce the idea that the global demand for new, fuel-efficient aircraft is so strong that airlines are willing to look past Boeing's recent history to secure their slots in a massive, decade-long backlog. Airbus is effectively sold out for years, so Boeing is the only other option. When you look at the monthly delivery numbers, they seem to confirm this progress. Boeing delivered 53 aircraft in October, including 40 of those crucial 737s. Year to date, they've shipped 493 planes. These are the strongest figures we've seen since 2018. So the expectation is set. Production is rising, orders are coming in, and the stock, while off its highs, is on a clear recovery path. This is what the average person using the Robinhood app or looking at investing sites probably sees. Now, let's challenge that. Let's look at the reality that those analyst price target cuts are pointing to. The problem is that this ramp-up is staggeringly expensive. The Q3 earnings report on October 30th was a perfect example of this. On the surface, a revenue beat. Great. But investors who looked past the headline saw the real story in the cash flow statement. Boeing is still burning cash at an alarming rate. That report showed a free cash flow loss of $8.1 billion. To fix the 787 production, the company is sinking $1 billion into its South Carolina facility just to get the build rate from 8 per month to a target of 10 per month by 2026. This isn't the kind of high-margin, low-capex business model you see with Apple stock or Nvidia stock, which seem to print cash. This is a heavy industrial business, and right now it's in a phase of massive reinvestment. This is the reality that many online investing platforms don't fully capture in their simple buy ratings. The company is spending a fortune today in the hope of massive cash flows in 2028 or 2029. Analysts are projecting they could hit $12.8 billion in annual free cash flow, but not until the end of the decade. That is a very long time to wait, especially in a high interest rate environment where that future cash is worth less today. And this only covers the commercial airplanes division, BCA. We haven't even touched the other side of the company, Boeing Defense, Space and Security, BDS, which has become a financial anchor tied to the ankle of the entire corporation. The expectation is that Boeing is a prime defense contractor, a pillar of national security. The reality is that its defense division is a financial disaster. The company is projecting it will log another $1.7 billion in losses in the fourth quarter alone. This will bring the total 2025 loss for the defense unit to a staggering $4.9 billion, which is worse than the $4.4 billion it lost in 2022. Why? A portfolio of toxic, fixed-price contracts signed years ago, where Boeing, not the government, is forced to eat every single cost overrun. We're talking about the KC-46 Pegasus tanker, which just triggered another $800 million loss. The T-7 Red Hawk trainer, another $500 million loss. Add in the overruns on the VC-25B, the new Air Force One, the MQ-25 Stingray drone, and the perpetually troubled Starliner space capsule, and you have a division that is systematically destroying shareholder value. While the commercial side is fighting to generate cash, the defense side is burning it by the billion. This is a critical risk that many self-investing retail traders, perhaps using Robinhood fractional shares to get a piece of BA, might be completely overlooking. So how are the big players handling this? We can look at the institutional 13F filings, which show what firms managing Fidelity mutual funds or massive private accounts are doing. The ownership is high, with over 3,200 institutions on the books, but the recent activity is very telling. Capital Research Global Investors, a huge shareholder, reduced its position by almost 12% in the last filing period. Newport Trust Co. also cut its stake by over 5%. At the same time, you see complex option activity. Bank of America, for instance, is holding massive put and call positions, essentially hedging its bets, expecting a big move but unsure of the direction. This isn't the kind of simple all-in conviction you see in a stock like Tesla stock during its bull run. This is caution. This is professionals at Fidelity Brokerage and Interactive Brokers building complex positions to manage risk because the company's future, while promising, is also incredibly uncertain. This is why many investors simply opt for Fidelity ETFs or a Schwab Intelligent Portfolio service to get exposure to the industrial sector without the single stock headache that Boeing represents. Let's also not forget the risks that are still on the table. The biggest one? The 737 MAX 7, and more importantly, the MAX 10, are still not certified by the FAA. The MAX 10 is Boeing's direct competitor to the runaway success that is the Airbus A321neo. Major customers like United and Delta are waiting for this plane, but as of right now, there is still no clear timeline for its approval. This is a massive piece of the future cash flow story that remains a question mark. Any further delay, any new regulatory hurdle could send a shockwave through the stock. This brings me to a question for all of you watching.